Look at this line. If you understand what this shape represents, you should be terrified. If you don't, you're about to become the exit liquidity for the wealthiest institutions on earth. The white line is Cisco Systems in March 2000. At that moment, it was the most valuable company on the planet. It was the plumbing of the internet. You couldn't build the future without it. Analysts said it would become the first trillion-dollar company. They said valuation didn't matter because the internet changed the laws of economics. Then, in 24 months, it lost 80% of its value. $400 billion in wealth vaporized. It took 21 years, or 2 decades, for the stock price to return to its 2000 high. Now, look at the red line. This is Nvidia in 2025. The shape is identical, the narrative is identical. You can't build AI without chips. This time is different. The laws of valuation don't apply. But here is the paradox. Nvidia is a real company. It makes real money, just like Cisco did. The technology is revolutionary, just like the internet was. And that is exactly how the trap works. They don't trick you with vaporware. They trick you with the truth. They take a genuine technological revolution and inflate it into a financial weapon that transfers wealth from your pension fund to their balance sheet. Today, I'm going to show you the anatomy of a mania. We're going to deconstruct the CapEx Cliff, the mechanism that killed Cisco, and the exact same mechanism that is flashing red for Nvidia right now. This isn't about predicting a crash. This is about understanding the architecture of the bubble. Because once you see the chart, you realize we aren't investing. We're repeating history. To understand where we are, we have to go back to 1991. The world was discovering the internet. It's hard to explain the hysteria to someone who wasn't there. It wasn't just optimism. It was really just fervor. The thesis was simple. The internet is going to connect every human being on Earth. To do that, we need routers. We need switches. We need infrastructure. Cisco Systems made the routers. They were the pick and shovel seller in the gold rush. And the numbers were staggering. Cisco grows revenue by 50% year over year. Its gross margins were 65%. It was a money-printing machine. John Chambers, the CEO, was treated like a prophet. In every interview, he said the same thing. The internet revolution is just beginning. And he was right. He wasn't lying. So, Wall Street did what Wall Street is designed to do. They extrapolated. They took that 50% growth and projected it out for 10 years. By March 2000, Cisco was trading a price-to-earning or PE ratio of nearly 200. Let me explain what that means. A PE of 200 means that if Cisco's earnings stayed flat, it would take 200 years of profits to pay back your initial investment. Why would anyone buy that? Because of the greater fool theory. Institutional investors, the banks, the hedge funds, they knew the math didn't work. They knew a router company couldn't be worth more than the entire energy sector. But they also knew that you didn't know that. They knew the retail public was cashing the narrative. So they bought, drove the price up, and waited for the greater fool to buy the bags at the top. And the narrative was airtight. The internet is the future. If you bet against Cisco, you were betting against the future of humanity. But on March 27, 2000, a report was published in Barron's. It asked a simple question. What happens when everyone who needs a router has a router? It was the question nobody wanted to ask. Saturation. Within weeks, the selling started, not by retail investors, by insiders, by the institutions. The bubble didn't pop because the internet failed. The internet succeeded. We all use it today. The bubble popped because the expectation of future growth became mathematically impossible to fulfill. Cisco fell 89%. It didn't go bankrupt. It's still a massive company today, but if you bought at the top in 2000, you lost a generation of wealth. Fast forward 25 years, the technology has changed. The trap hasn't. Instead of the internet, the revolution is artificial intelligence. Instead of routers, the infrastructure is the GPU, the H100 chip. And the company is Nvidia. Just like Cisco, Nvidia is a real business. In fact, it's a better business. Their margins are insane, over 75%. They have a practical monopoly. If you want to train a model like GPT-4, you simply cannot use anything else. And just like 2000, the growth is staggering. Nvidia went from $300 billion company to a $3 trillion company in roughly 18 months. But look closer at the buyers. Who is buying these chips? In 2000, Cisco's customers were telecom companies. They were borrowing billions of dollars to lay fiber optic cables and install routers, hoping that eventually customers would pay for it. Today, NVIDIA's customers are the hyperscalers: Microsoft, Meta, Google, Amazon. These four companies account for nearly 50% of NVIDIA's revenue. They are spending hundreds of billions of dollars to build AI data centers. This is where the chart becomes terrifying. We are in what economists call the build-out phase. In every technological revolution, railroads in the 1800s, radio in the 1920s, internet in the 1990s, there is a frantic rush to build the infrastructure. During the build-out, the shovel seller looks invincible. Their earnings go parabolic. But eventually, the railroad is built, the fiber is laid, the data centers are full. And then comes the question, where is their revenue? Microsoft is spending $50 billion a year on AI hardware. Are they making $50 billion back from AI subscriptions? No, they're making a fraction of that. They are buying the chips because they are afraid. They're afraid that if they don't buy them, Google will. It's an arms race. This is called defensive spend. It's not based on current profit. It's based on fear of irrelevance. And history tells us exactly how defensive spending ends. It stops abruptly. The moment Google or Meta decides, okay, we have enough compute for now, Nvidia's order book collapses. And because Wall Street has priced Nvidia as if this growth will continue forever, even a small slowdown causes a catastrophic repricing. The chart matches because the psychology matches. We are linear thinkers in an exponential trap. But this isn't just about two companies. This is about a system that inflates these bubbles. It was designed by specific men to function this way. Let's look at the architects of this specific recurrence. Architect 1, the enabler, the Federal Reserve. In the late 90s, Fed Chair Alan Greenspan famously warned of irrational exuberance, but he did nothing to stop it. In fact, he kept liquidity flowing specifically to ward off the Y2K bug scare. The market was flooded with cheap money. Today, Jeremy Powell is the architect. During the pandemic, the Federal Reserve printed 40% of all US dollars in existence. That money didn't go into wages, it went into assets. When you inject trillions into the system, it has to go somewhere. It seeks the highest growth narrative. In 2021, it was crypto. In 2024, it funneled into Nvidia. The bubble is not a mistake. This is a symptom of excess liquidity. Architect 2, the visionary seller, the CEO. Jensen Huang is a genius, but he is also a salesman. Listen to his language. He calls AI the new industrial revolution. He tells governments, sovereign nations, that they need sovereign AI. He's creating a sense of national urgency. He isn't just selling a chip, he's selling national security. This amplifies the demand. It forces governments and corporations to buy now, regardless of price. He's maximizing the FOMO, or fear of missing out, at the peak of the cycle. Architect 3, the Wall Street hype man. In 2000, analysts had strong buy ratings on stocks that had zero revenue. Today, look at the price targets for Nvidia. Every time the stock hits a target, they raise it. $800, $1,000, $1,200. Why? Because investment banks make fees on trading volume. They need you to buy. If they tell you the top is in, the volume dries up. Their business model requires the bubble to inflate as large as possible before it bursts. So, how does it break? What is the pin that pops the bubble? In the semiconductor industry, there is a phenomenon called double ordering. Imagine you're a server manufacturer. You need 800 chips. Nvidia tells you there is a 12-month wait list. You're panicked. You can't wait 12 months. So you order 10,000 chips from Nvidia. But just to be safe, you also place orders through distributors. You overorder because you assume you'll only get 50% of what you ask for. Nvidia looks at its order book and sees massive demand. They ramp up production. TSMC, the manufacturer, builds new factories. But this demand is phantom, it's artificial. Suddenly, supply catches up. The wait list drops from 12 months to 1 month. The customers realize they don't need to hoard chips anymore. They canceled double orders. Overnight, the infinite demand evaporates. Inventory piles up. Prices slash. This happened to Cisco in 2001. They had to write off $2.2 billion in inventory. They literally threw brand new routers into the trash because nobody wanted them. We're seeing early signs of this now. The lead times for GPU chips are shrinking. The scarcity is ending. When the scarcity ends, the pricing power ends. And when the pricing power ends, the margins collapse. As when the margins collapse, the stock price, which is priced for perfection, falls off a cliff. Now, I have to be intellectually honest. If you talk to an Nvidia bull, they will tell you I'm wrong. And they have one very strong argument. The argument is Cisco had competition, Nvidia doesn't. In 2000, Cisco was fighting Juniper, Nortel, Lucent. In 2025, Nvidia is essentially alone. AMD is trying, Intel is failing, and Google is making their own chips, TPUs, but Nvidia's software mode, CUDA, is impenetrable. Developers are locked into Nvidia's ecosystem. It is much stickier than a router. Furthermore, the cash flow is real. Nvidia is printing billions in free cash flow every quarter. They are buying back their own stock. Many dot-com companies had no profit. Nvidia has profit margins that would make a drug cartel jealous. Does this save them? No. It prevents them from going to zero. Nvidia will not go bankrupt. It will remain a dominant, important company for the next 20 years. But remember the chart. Cisco didn't go bankrupt either. It just went from $80 to $10. The stock is not a company. The stock is a claim on future sentiment. You can have a great company and a terrible investment. If Nvidia's growth slows from explosive to just great, the stock creates a vacuum. The multiple compression alone, going from a P of 70 to a P of 30, would cut the stock price in half, even if earnings stay flat. Here is the part that affects you, even if you don't own a single share of Nvidia. You might think I'm safe. I just buy the S&P 500 index fund. I'm diversified. You're not diversified. You're concentrated. The S&P 500 is market cap weighted because Nvidia, Microsoft, Apple, Amazon, and Google have become so large they make up nearly 30 to 35% of the entire index. This is the highest concentration in history, higher than the dot-com peak. If Nvidia sneezes, your 401k catches a cold. The passive investing boom, the idea that you can't just buy the market, has created a feedback loop. When money flows into the S&P 500, it automatically buys more Nvidia, pushing the price up, which increases its weight, which forces the index to buy even more. It works beautifully on the way up. It's a mechanism for infinite liquidity. But mechanics work both ways. When the selling starts, the passive funds become for sellers. The loop reverses. The entire market is leveraged on the performance of a single microchip architecture. This is not a stable financial system. This is a house of cards resting on a GPU. So, what do you do? If you own Nvidia, do you sell everything? I'm not a financial advisor, but I'm a student of history, and history teaches us one rule. Manias last longer than you think and end faster than you can react. In 1991, if you sold Cisco too early, you missed 100% gain in 6 months. But if you held one day too long, you lost everything. Step 1. Rebalance. If Nvidia has become 20% or 30% of your portfolio simply because it went up, you're playing Russian roulette. Professionals rebalance. They sell the winners to buy the laggards. It feels bad to sell a winner, but it's the only way to lock in the wealth transfer. Step 2. Look where the crowd isn't. When everyone was buying tech in 2000, value stocks, energy, and real estate were cheap. When the bubble burst, those boring assets outperformed for a decade. Today, commodities, energy, and small caps are ignored because they aren't AI. That is exactly where the safety lies. Step 3. Watch the insider selling. Jensen Huang has been selling shares. Jeff Bezos has been selling Amazon. Mark Zuckerberg is selling Meta. The architects are cashing out. They are ringing the bell at the top. If the CEO is selling, why are you buying? Let's look at the chart one last time. $38 trillion. That is the size of the U.S. national debt. The system requires inflation. It requires bubbles to keep the illusion of solvency alive. The AI bubble is the latest mechanism to absorb that liquidity. Nvidia is a great company. The internet was a great invention. But the stock is a vehicle for emotion. The chart of Cisco in 2000 is a monument to human greed. It's a tombstone for the capital of millions of retail investors who thought trees could grow to the sky. The chart of Nvidia in 2025 is currently being drawn. The pen is in the hand of the market, but the ink is your money. The architects, the bankers, the Fed insiders, they have already designed the exit. They know that eventually the build-out phase ends. They know the capacity glut is coming. They are waiting for the moment when the last retail investor buys the narrative so they can sell the reality. Don't be the liquidity. If this analysis helped you see the matrix behind the ticker symbol, if you understand now that a stock chart is just a map of mass psychology, subscribe. Because the next bubble is already being engineered. And I want to make sure you see it coming before the rest of the world does. History doesn't repeat, but the trap is eternal.